Welcome to Strategic Alternatives, the RBC Capital Markets podcast. In this episode, you'll hear a roundtable discussion from RBC's Global Technology, Internet, Media, and Telecom Conference in New York, which brings together perspectives from across the investor lifecycle, venture capital, institutional investing, and private equity, to explore where AI and technology markets are headed. From early-stage innovation to long-term positioning and scaled growth, each lens offers a different view on how today's tech trends are taking shape. The conversation is led by Matt Hedberg, head of Global Technology, Internet, Media, and Telecom Research here at RBC Capital Markets, who speaks with David Golob, Chief Investment Officer at Francisco Partners, Greg Turorto, Portfolio Manager at Goldman Sachs, and John Borthwick, CEO of Betaworks. Now, let's dive into the conversation.
Well, thank you all for joining us. We've done this panel now for many, many years. It's always one of the highlights for me. And so we've kind of got the full gamut here of investors, and we're going to cut through some of these major topics that are on everybody's mind. But maybe just post-COVID, software was trading at sky-high multiples. Until very recently, AI stocks were seemingly going to infinity. But now some of these things have been under pressure recently. And we'll talk about where we are in this AI super cycle in a second here. But from your perspective, what are some of the biggest mindshare shifts in how investors are evaluating technology companies? And Dave, is there a way to think about how that might impact our 2026 thinking?
What's interesting in the last several months is that there's this narrative that somehow applications are going to get disrupted by AI and infrastructure. People are going to just spend more money on the build out. And historically, infrastructure is much more churny, lower retention rates.
Yep.
Engineers like tinkering, and the end user doesn't have to see the change, and it's all about performance as opposed to being embedded in the workflow. So I am surprised by that diversion, and it is not consistent with our experience of what's happening in the portfolio.
Interesting. Anything else? So we can get to AI in a second here, but anything else stand out, John?
I'll make an observation, which is I've been in the early stage technology business for a while now, and I started my first company in 95. So I have a ton of muscle memory around dot-com bubble and dot-com bust. And so I'm constantly just like calibrating against that as an experience. However, this is fundamentally different. And the reason why it's fundamentally different would be dot-com bubble. Most of the bubble was on the infrastructure side, on the network side. We were laying a network and building out a network for fiber, for broadband, in anticipation of broadband. And this time, as fast as we're laying the infrastructure, we're using it, right? So there's just a completely different forward planning thing. Secondly, I would say is back then we were creating and building a network. Today, we're actually upgrading intelligence in every corner of compute that exists. And so it's very different to a network, and it is far more fundamental. And then lastly, I would say we have billions of people online. Reportedly, Google did about 5 trillion searches last year. I mean, it's not disclosed, but somewhere in orders of magnitude of that. And what we're seeing is, I often think about the general AI platforms like OpenAI as everything machines. And they are trying to basically give us a much more comprehensive version of search. We're seeing that behavior actually happen. So when you step back and you see OpenAI go from 300 million users this time last year to about 700-800 now, on one hand you say, God, that's extraordinary. And then on the other hand, when you put it through the prism of everybody upgrading how they use search, it's actually pretty obvious. So it's different.
I ask where we are in this cycle here, but Greg, you've been investing in tech companies for decades. How do you, as a public-facing investor, compare this AI cycle to past cycles that you've been involved with?
And I do think it is fundamentally different. One of the things I've tried to step back and detach a bit more about is the enterprise or the knowledge worker approach to this, because we've gone through the different instrumentation across people, like moving into like a utilization phase.
Yeah.
If you're not using AI at your job, you're behind. So when you think about the different things that like deliver answers and change the way people's jobs work, is the junior analyst at an investment banking firm, is their job completely obsolete? No, but it's changed a bit. And I think that one of those things in terms of like how you think about what the TAM is at each company, and like how we created the unit economic model, which started at like the deal, and then when it went past the deal, it went to the number of salespeople and then the number of workers in terms of creating headcounts. We have to change all those. And like if you're just looking at like, oh, each deal is 50,000 per, and like you're not going to get anywhere. Yeah. It's just a treadmill. So really detaching and looking at these things in terms of like what they can be as opposed to what they once were.
John, you said something a couple things that were really interesting. In this AI cycle is really a compute upgrade in many regards, and the world is clearly short AI compute capacity. At this point, to hit the obvious question, his bubbles are only evident in hindsight, and we won't know until we after the fact. Are there any indicators that you're looking at to judge where we are in this AI cycle?
When you see a lot of tourist investors showing up in deals, that would be a signal to me that was reaching the peak, where there's a lot of money coming from the fringe. Secondly is the lack of transparency in some of these deals between the hyperscalers and between different layers in the stack. That stuff is concerning because you just don't know how connected their destiny is. You just don't know. So that one, I would say, is more of a flag. Also, you have to step back. We're putting intelligence into everything. And that is the most transformative thing I'll see in my lifetime. It's an amazing time to be alive, to be building, to be investing, to be doing what we're doing. But I think that there's a bubble right now in LLMs reaching capacity of what they can actually do. That doesn't mean that AI won't go further, because there are other technologies that are very interesting that can either augment LLMs or can surpass them. And so the overall wave is this intelligence wave, and you need to keep your eye on that.
Any other observations from either of you?
The yellow flag, I agree with you on the reciprocal transactions. And the question I always ask myself when you see these in the news is like, well, why not double it? Okay. Like seriously, like we're trading our chips for your capacity. Let's say it's 2 times more. Like, why not? Like, so it's fake, right? At some level. So that is a yellow flag, but it doesn't necessarily mean that the end is around the corner. And I agree, it's probably going higher. If we get to a point where NVIDIA is doubled again and it's trading at a much higher multiple, and then they come in with a soft guide or a miss, like, look out below. NVIDIA is a great business. Like, it's a great business. There are other companies that are starting to get public that are doing things that are much lower IP, much lower defensibility, providers of flex capacity, negative cash flow, unfunded business plans, huge multiples. And those are the businesses that you look at and you say, that's like a WorldCom type of situation. That's like an Exodus type of situation. That thing could be bankrupt in 2 years.
Go ahead, John.
Just to add to Dave's points, I try to keep my eye on externalities, because now technology is of geopolitical and importance in every way, shape, or form. And so
the 2 governors' races were about, they talked about power.
Yeah.
Like, so it's like, that's the externality. And not everybody is as well thought out to realize where the power costs are being driven up, but they played on it. And it resonated with people, both in New Jersey and in Virginia, where there's a lot of these data centers.
The geopolitical externality factors here are sort of I wouldn't call them a yellow light, because you don't know, but when they show up, they could become a yellow red light quickly, because this technology is so fundamental to what it means to be a nation state or a citizen or to be a human.
For sure. Greg, how do you think about AI's impact on software and tech investing?
When you talk to software execs, especially ones that have either recently exited the business or sold their companies or thinking about trying to go public, one of the things that they struggle with is this. It's either, is this a binary type situation, or can these things coexist? There is a coexistence path for many of these things, but one of the things that a lot of our publicly traded companies got lazy with was, you and I talked about it with one company earlier, is like these short and long-term plans that they give out at their analyst days and other things are embedded in models. They're embedded in valuations. They're embedded in the tiers that companies used to live in the software comp table, right? And I think that once you lose faith that the company has a handle on it, you can debate expansion rates. You can debate new customer additions. You can debate what deal sizes may look like in the future. And that's something that people start to need to be a little bit more deeply granular on, because you may not get a chance to make a mistake on those things, because your company that traded at 7 times sales may now trade at 4, and you may not break into that 6 to 8 range again if people don't think you're predictable. So that's one piece of it. that the second piece of it is how you enter the fray. If you talk to a lot of the capital markets folks, the only thing that says seemingly worked is small IPO floats. Like the 12 million share deal that became a 10 million share deal is now a 7.5 million share deal. And that makes it even more clubby and even more tightly allocated. And does that mean that everybody has to hold hands and say, we're not going to ever sell this thing until it gets to a point of exit velocity, or does everybody sell at the same time? And that's a little dangerous. If you look at the last round valuations for a lot of these companies before they go public, they're really high, and nobody wants to take a down mark. And so that clearing price in the equity markets may have to be adjusted, where some people have to take a down mark, and it may be the last ones in that do that to get to a point where we have a more fulsome trading environment.
One of the paradigm shifts with AI is certainly pricing and packaging. John, you were an early investor in Hugging Face. What is some of your counsel that you're giving to some of your early round investments on how they're building businesses?
I think that generally we lean very hard into truly native applications. And part of the native application is about thinking about pricing differently. And so outcome-based pricing is how we're seeing quite a few of our companies start to lean into. And if you think about it, it aligns much more obviously with business, with customer interests. And one of our companies is building a end-to-end recruiter replacement, which is an agent that does all the job of a recruiter. Everything from soliciting, finding candidates, all the way to making them offers. And he prices on performance. And so, and his trade is that he's thinking, okay, I could have people doing this and run a recruiting firm, but with agents, I can have tens of thousands of them simultaneously. Another observation on the native side is we're thinking a lot about interfaces. And so what do I mean by interfaces? We recently sold a company to OpenAI, which is called Sky, that was a pre-release company. And so there's only about 100 testers on it, so it's not public what the company did. But what they did was, what I have on my desktop is Sky interface that lets me cut across all these databases. So instead of having to go to an app and then make a query, how many times have we cut, copy, and pasting? We as humans are taking data from here and recontextualizing it, put it into another database here. I mean, hello, that is we can get some productivity gains, right? And so that's what Sky is. So we're seeing companies completely reinvent what it means to be an app.
Dave, from your perspective, you're buying public companies oftentimes that are seat-based models. What is your counsel to some of these companies that might have to think about unit economics differently in the future?
We generally view technology as a risk factor as opposed to an opportunity. And so our business model is to identify fundamentally sound companies that we can improve. What we typically do is buy companies that have, for example, financial incentives in the management team to pursue growth, even when the organic growth rate that's achievable in the market is just not what it used to be. There's an S curve to the development of many interesting but finite markets within tech, especially in lots of verticals. And companies go public or they're just divisions of larger businesses, and they grow quickly, and then the growth rate slows. And the incentive of the team is generally to say, how much can I spend so that I can get my growth rate back to what it was?
Yep.
And so the profits go way down. And meanwhile, usually it doesn't really make much of a difference to the growth rate. And so we can then buy companies that trade. We're seeming to pay a high earnings multiple, but really there's just a lot of extra spend that went in that was unproductive that we can then take out. The good news is we don't really need to exit at super high valuations to make money, because generally once we've done the transformation, we're getting paid a good cash flow yield.
Dave, how do we think about efficiencies with AI? What is your lens on valuation today, and how does maybe that differ from 10 years ago?
But outside of infrastructure, everything is clumped in terms of the valuation opportunities. It's a lot harder to make the differentiation argument in what you're doing just in terms of looking at valuation. So I think that what you're trying to look for is just stability in terms of where things are. So it's not looking for the lowest expectations, but making sure that the expectations, going back to what I said about Analyst Day and medium and long-term projections, are realistic and reasonable. And they have the things on their books that actually can do it. Do they have the people that can put forth those things? Or if some companies making a bet that, we're going to grow into that valuation because we're going to do an acquisition. And so you look at a lot of different areas, especially when you get deeper into some of the verticals, when there's a penetration game going. And if that penetration has a certain level of speed, if that speed slows down, that could be a significant change to where the valuation envelope could be. So trying to look at a lot of things, which makes you in turn consolidate your portfolio, consolidate your holdings, and really focus on the things that are knowable as opposed to not just hopeable.
John, when you think about moats today, what are some of the most important moats that you look for as an early stage investor that you think give you the best odds of a successful outcome?
I think the stack has been in flux. I'd characterize the first year as being like this extraordinary moment with OpenAI, and it seemed like Google would have a run of the table, OpenAI/Microsoft. The three of them would have a run of the whole table. So in the second year, you start to see many state-of-the-art closed models. So today, we're probably at 10, 15 of them. We also cycle to open source and the commoditization cycle, where I often track how fast is it for a state-of-the-art model to become freely available in open source. And today, depends on the model, but today's like 4 months. And it was 8 to 9 to 12 months once at the beginning. And this year we've seen a third phase. So if the second phase was about sort of dispersion and proliferation, and also all these SLI, sort of small language models, very specific use cases, many of them open source. This third year, this year, we've seen a divergence where OpenAI are trying to be the tightly coupled Veblen machine. And then I think that the other models, each of the models is starting to get their own flavor, which are moats in of themselves. Like, I think before I'm going to do something, I'm thinking, okay, this is probably an Anthropic thing. Maybe this is Grok. Maybe this is OpenAI. And so we're seeing the distinction, and the distinction comes in many forms. One of them is context window and speed, but there's also the flavor of it. I mean, the models just have a different flavor on how they process data. And then another moat that I do think about quite a bit is local data and highly specific data, because these models are very hungry for data.
Any observations on a technology that you think the market is overestimating right now?
I don't understand quantum, so that'd be one. Doesn't mean, and I think there's some stuff in fusion, so those would be examples.
I'll take humanoid robots. It's the humanoid bit which is the problem. We have been obsessed through natural sci-fi-like things to think that robotics should be humanoid-like. We're going to think of a massive proliferation of robotics, but single-use robotics, like this, like clanky humanoid robot walking around. That is overrated because it is very complicated.
What about one underappreciated technology other than AI?
I'd say memory chips. I've been really surprised in terms of how that's come back into vogue.
Well, I think the human compute interface and mental health and also digital medicine, there is like emerging evidence of potentially dramatic ability to address disease. And obviously the GLP-1s have gotten all this attention. Longevity, even things like direct brain stimulation, you can now do it in a very precise way. And we're just at the beginning of putting AI into this. And it also applies to fields like cancer and Alzheimer's. And for the first time, like, there's legit scientists who are optimistic about preventing Alzheimer's, just to pick one example.
Yeah. Go for hallucinations. One of the things that's extraordinary about these models and thinking about them is you have really for the first time, we have non-deterministic, probability-based math and systems. And we've been working really hard for the last couple of years to make them predictable, right? To eliminate the hallucinations, which is perfectly justifiable in business processes and where you will need predictable outcomes. You need to ingest all this data and you need to have a predictable outcome. Fine. But the hallucination side of these models, where they can start to explore the search space or the possibility space, I think the hallucination side of these models and figuring out how we can turn that into things that actually work for us as people, hugely interesting.
I always like to think about some of these moonshot predictions. And Dave, you suggested the healthcare element. That certainly feels very moonshot to me. But are there any other things, and John, you probably have lots of things rumbling around your head that could be some of these moonshot initiatives?
We're in the midst of it, is that we still had all these models that have been the multimodality side of these models, about how you move from text to voice, from voice to images, I still think is, we're just getting there and is very underappreciated.
Mm-hmm.
And so most people are chatting to GPT or they're chatting to Claude. But now that you can take a photograph of anything, to say, tell me what this is, and then chat with it, and then turn it into something else. So we're seeing other things. We're seeing other modalities.
Greg, what about any moonshots that you're thinking about?
There's so much going on the space side that I actually do think that if we think about 5 years, not one, that I don't think we're going to be living in space or colonizing the moon or Mars, but I do think we'll get to a point where some of this stuff there's so much money being thrown at it that there will be revenue generating and money making opportunities for people that don't own Prometheus or SpaceX in some way, shape, or form. Is it some degree of mining for rare earths in space or something like that? There's just, if you listen to some of the space, even like some of these aerospace defense companies that have tried to go public, like there are so many launches that are happening that somebody's bound to find something.
I appreciate everybody staying around a little bit longer. We do appreciate your time, all three of you guys. Thank you for coming, and look forward to next year.
Thanks, Matt.
Thank you, Matt.
Thank you for listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on November 19th, 2025. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you get your podcasts. If you'd like to learn more or continue the conversation, please visit rbccm.com/strategic alternatives or contact your RBC representative. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.